Hello and welcome to our Oregon portion of the basic tax course. We are going to cover Oregon tax law over a series of 4 sessions, each session building on the previous session, just as we have always built on prior sessions in the federal portion of our basic tax course. The first class we will cover includes Oregon filing requirements, Oregon penalties, and Oregon filing status. In part 2 of the course, we will focus on Oregon additions and subtractions, Oregon deductions, Oregon credits, and other Oregon returns. In Part 3, we will look at Oregon Non-Resident Form 40N, Oregon Part Year Resident Form 40P. And then we will finish this portion of the course up with Oregon License Law, Code of Conduct, Rules of Conduct, Examination Information, and Sample Tests. Now, I did want to point out that the Oregon portion of this course is using a manual that combines Part 1 and Part 2 into a single manual. So just follow along in the manual as we go, and when we say stop and work on classwork or work on homework, we mean to that point in the manual. And then, of course, when we get to the next part in the manual, we'll have you pick up there. So with that, you're going to begin watching some live classes. The methodology behind these recordings will look a little bit different than what you've seen for most of the other sessions in the basic tax course, because I did teach Welcome to Oregon as a live class in the spring of this year, and you're going to be watching videos that I recorded at that time. But periodically, the videos will be interrupted with a separate recording, and that separate recording will contain instructions on how you are to proceed as a basic tax course student. Thank you, and have fun. So we're going to begin with filing requirements, and Oregon's filing requirements are different than the federal filing requirements. In general, the income threshold for Oregon returns is lower than it is for the federal. So what that means is, even though you have a client who may not meet the federal filing requirement, there's a good, strong likelihood that they still have to file an Oregon return. So I frequently get questions from my clients who say, my kid earned this much money last year. Are they required to file a return? And my answer will be, yes, Oregon, no federal. And then they scratch their head, how is that possible? Well, let's take a look at some of these numbers. And there's 2 charts that I've put for you side by side. And your filing requirement is dictated by your residency status. So if you are a full-year resident, you go to the full-year filing requirement table. And if you are a part-year resident, you go to the part-year filing table. The significant difference between these 2 tables is that the part-year filing table specifically refers only to the Oregon standard deduction. So if you are a part-year or a non-resident of Oregon, your filing requirement for Oregon is the Oregon standard deduction. If you are a full-year resident of Oregon, the filing requirement is higher than your standard deduction. Now, if we think over to the federal return and how filing requirements are established on the federal return, there is a certain amount of logic to it. At the federal return, if you are trying to determine if someone is required to file a return, you'll say, okay, you've got their standard deduction, and what is the standard deduction for a single person? Federally? $5,700? I've been teaching it for weeks and I still forget. So $5,700 on the federal return is the standard deduction, and then the exemption amount for 2010 is $3,650. So essentially, you take those 2 numbers and add them together, and you have the filing requirement for the federal return. So it seemed to me early on when I was studying Oregon law that there must be some similar rationale to Oregon. I'm going to show you what I figured out, because I have the kind of mind that likes to puzzle through these things. So unfortunately, the theory or the methodology I came up for figuring out what Oregon's filing requirement is works only on one filing status, and this has been universal throughout all the years I've taught, and that is head of household. So I'm going to show you what I figured out. What is the lowest income tax bracket in Oregon after 0? Who knows? No, not 3. I can see you need to be here. No. The lowest actual tax rate that applies to Oregon filers is 5%. So Oregon, did you know, has a 5% bracket, a 7% bracket, a 9% bracket, and now, of course, it has its 10 and 11% brackets as well, roughly speaking. But for all of the history of Oregon that I've been here, we've really essentially only had 3 brackets until 2009, when we as voters voted in higher rates for higher income people. But we universally think of a 9% bracket because virtually everyone is taxed at that rate. But there are two lower rates, 5% and 7%, and it's the 5% rate that factors into the filing requirement for Oregon. And what is the personal exemption deduction for 2010? 177, I think? Right? Okay. So does anyone have a calculator and can tell me real quick what happens when you take 177 and divide that by 5%? You're going to get a number. 3540? So 3540. And let's take that and add that to 3140, because I said this would work for head of household and nowhere else. What's the total of those two numbers? 6680, thank you. Okay, so that is how Oregon has determined the filing requirement for a full-year resident who is head of household filing status. They've essentially taken the personal exemption amount, divided it by the lowest tax bracket of 5%, and that gives you a number, 3540. They then add that to the standard deduction for head of household, and you now have the filing requirement for head of household. Now you can apply that same formula to all other filing statuses, but you're always off by up to $100. So if you're sitting there in your heads, and I don't believe that the Oregon exam will ask you for these numbers anyway. I think they give you that cheat sheet now, I think, which probably includes these numbers on them. But back when I was taking tests, they didn't give you a cheat sheet. You had to know this stuff. And so in my mind, I wanted to know where the numbers came from, and this was what I discovered. So let's move on and just take a look at what we've got going here for Oregon. The single filing status, as on the federal return, does increase if you hit age 65. But you'll notice that the filing requirement is not increased by blindness. So as on the federal return, blindness is not a factor in filing requirement, even though it is a factor in the standard deduction. So Oregon says if you are single and under age 65, your filing requirement is 5340, and if you're age 65 or older, it moves up to 6540, and the difference between those two numbers is $1,200. If you move over to married filing jointly, the filing requirement is $10,700, and if one of you is age 65, it goes to $11,700, and if both of you are age 65, it goes to $12,700. So what that is telling you is that the additional standard deduction for being age 65 is $1,000 for married people, and it's $1,200 for single people. Down on children, it does say that children have different filing requirements than the non-dependent people. And of course, the filing requirements for dependents, how you calculate the filing requirement for a dependent is the same as how you calculate the filing requirement for federal. It's just at the federal level, you are allowed to go as high as $5,700 on income if the child's income all comes from wages, because that's the standard deduction at the federal level. But on Oregon, the standard deduction for a single filer is $1,950. So that's where I said at the beginning, you could have a dependent who's not required to file a federal return because their income is well under $5,700, but it could easily be $1,950, couldn't it? So that's something to particularly watch for on dependents. And of course, when you are talking about dependents, you start with the larger of $950 or the earned income plus $300. So the minimum filing requirement for a dependent will be $950, and that is if the child has income only from investments and no wages. So pension income would also fall in there, capital gain income. So with dependents, the maximum the filing requirement would be is $1,950, unless of course they're blind or age 65, right? But it could be more than $950 if they have earned income. And when they have earned income, you take whatever their earned income is and add $300, but never more than $1,950 for a single dependent. Now, one of the rules that Oregon has, which I find interesting to compare to the federal, is remember on the federal return that the filing requirement for a married filing separate person, you throw out the standard deduction and you're only left with the personal exemption as the base amount for being a filing requirement. Oregon has no similar test. So if you look at the filing requirement for married filing separate, it's the same as single. So in effect, the Oregon tables are saying that you may be required to file a federal return at $3,650 of income, but at the Oregon level, you're not required to file until your income hits 5340, because the Oregon formula for filing requirement is different than the federal. But to add confusion to the pot, Oregon does have this rule that says, in addition, file an Oregon return if you are required to file a federal return. So if the federal is saying a married filing separate person has to file at 3650, then in effect Oregon is saying you have to file at 3650, even though the filing requirement is 5340. So if you're confused, so am I. Oregon also says you should file a return if you had $1 or more of Oregon income tax withheld from your wages. All right, next up is, which form do I use? The state of Oregon offers 4 different forms for completing your Oregon tax return, and knowing which form to use is an important first step when completing your tax return. Select one of the following forms as appropriate for your filing requirements. And of course, we have the Oregon long form, the Oregon short form, the Oregon part year resident form, and the Oregon non-resident form. Well, today we're going to focus on the Oregon long form, and most of our lecture is going to surround the reporting requirements for reporting income, additions, subtractions, credits on the long full year form. The reason for that is that there's so much that cannot be included on the short form. It's really a waste of time to spend talking about it. And then we're going to have an entire class that we devote to part year non-residents coming up. So if I'm talking about a particular addition or subtraction item, in most respects I will be talking about how it applies to the Oregon full year resident form 40. But you should be aware that most of the items that I talk about today also apply to part year and non-resident forms, but I'm not going to be going in and saying, oh, and it goes on this line on this form, and this line on that form, and this line on that form. I just want to kind of show you how it works on the full year resident form, and in our next class we'll get into how to divide it up on the part year residents. So beginning with Oregon Form 40, Form 40 is Oregon's equivalent of IRS Form 1040. If you were a full year resident of Oregon, you may use this form to report all forms of income deductions and credits attributable to income earned inside and outside of Oregon. Oregon Form 40S is similar to the IRS Form 1040. Most full year residents of Oregon who are eligible to file IRS 1040A can also file Oregon Form 40S, but do not confuse the requirements for using these 2 forms. A person who is eligible to file IRS Form 1040A cannot always file Oregon Form 40S. The following can be reported and claimed on 1040A, but not on Oregon 40S. Deductions including the student loan interest deduction, educator expenses, the IRA deduction, and the tuition and fees deduction. Income that can be reported on 1040A that cannot be reported on 40S includes pension income and capital gains distributions. Now, this is kind of just a side point that I wanted to make to you, in that these differences on the Oregon form have created problems in my own practice, because we try, when people call our office, to give them a good, accurate price estimate on what we're going to charge to prepare their tax returns. And after about 10 or 12 years of trying to train my tax preparers on how to know the difference between Oregon 40S and 40 requirements, I gave up and I made both forms the same price. Just, you know, you're trying to give a break for the short form, but the preparers inevitably could not figure out the differences in giving a price estimate, so finally we just made the forms the same price to get past that headache. And again, we also made part year non-residents and Oregon 40 and 40S all one price, because even having me to educate them, they couldn't learn it. But for you today, I just wanted to point out those differences, because they are relevant in terms of what form you are able to choose. And if you do happen to work for a tax service that does charge different rates for these forms, you need to understand these differences clearly in order to give a good estimate. Oregon Form 40P. If you or your spouse were part year residents of Oregon during the year, you should report your income on Form 40P. This form allows you to allocate the amount of income earned while you were a resident of Oregon and the income you earned while you were a non-resident of Oregon. Oregon Form 40N. If you or your spouse were non-residents of Oregon for the entire year, you should use Form 40N to report income earned inside Oregon while you were a non-resident. Here is an illustration. Mary is a full year resident of Vancouver, Washington. She works in Portland. Mary also works part-time at a job in Vancouver. Mary must file Oregon Form 40N, and she will allocate her income between Oregon and Washington on the form. Filing requirements with respect to a decedent. As the federal has a specific form, Form 1310, if you were filing for a refund in respect of a decedent, Oregon too has its own form which serves the same function. When filing for an Oregon refund with respect to a decedent, you should file Oregon Form 243 if you are not a surviving spouse or court-appointed personal representative. Oregon extensions. If you file a federal extension, Oregon will grant you an automatic 6-month extension of time to file your Oregon return. You are not required to send an extension form to Oregon unless you are making a payment of Oregon tax with your extension, or you are not filing a federal extension, just an Oregon extension. So no action is required on the part of Oregon for filing an Oregon extension if you file a federal extension, as long as you don't feel you're going to owe Oregon any money when you do file. But if you do feel you're going to owe Oregon money when you file, then the money is due at the time of the extension deadline, which is in most years April 15th. So on or before April 15th, if you believe you're going to owe tax to Oregon when you finally do get around to filing your Oregon return, that would be the reason to file an Oregon extension. And the Oregon extension voucher is really just a payment voucher. That's the function that it serves. And of course, the only other reason to file an Oregon extension aside from when you owe is that you are filing your extension for Oregon only and you are not filing a federal extension. Oregon tax tables. If you are a full-year resident and your taxable income is $50,000 or less, you can calculate your tax by using the tax tables on pages 37 through 39 of the 2010 Oregon Income Tax Booklet for full-year residents. Oregon tax rate schedules. If you are a full-year resident and your taxable income is more than $50,000, you should use the tax rate charts on page 39 of the 2010 Oregon Income Tax Booklet for full-year residents. If you are a part-year resident or a non-resident and you have any amount of taxable income, you should use the tax rate charts on page 27 of the 2010 Oregon Income Tax Booklet for part-year residents and non-residents. So I've essentially got the two tables lined up next to each other. The first table comes out of the Oregon Full-Year Resident Booklet, and you'll note that it picks up where the table leaves off. So it doesn't offer a calculation methodology if your taxable income is less than $50,000. It says go to the charts. But if you go over to the part-year and non-resident table, that is where you see that it offers space for people who fall into that 5% tax bracket I was telling you about. So it's an examination of the tables that tells you that there actually is other tax brackets out there. So we have 5%, 7%, 9%, 10.8%, and 11%. So I was thinking that there's a 10% bracket. There's really a 10.8% bracket and 11% bracket. And then, of course, you can see in the tables where you cross over into higher income tax brackets. So the 5% bracket is applicable to taxable income that is less than or not more than $3,050. So it's really for only the first $3,050 of Oregon income that you fall into that lowest 5% bracket. Then there's another very short space of time where you are in the 7% bracket, and you're basically in that for another $3,600 of income. And then, of course, whammo, you move into the 9% bracket where you're stuck until your income hits, your taxable income hits $125,000. And from that point forward, your tax bracket increases to 10.8%. And then for those single filers who have $250,000 or more of Oregon taxable income, the tax rate moves to 11%. Each of those brackets or rates for calculation is doubled when the filing status is married or head of household. Oregon tax payment options. The following service provider accepts credit card payments for Oregon: the Official Payments Corporation. And this allows you to pay by credit card. And of course, if you pay by credit card, you will be assessed a fee by that corporation that will be in addition to any Oregon tax you owe. You can also have your payment electronically withdrawn from your checking or savings account at no charge. Just go to the Oregon website, follow the links to pay by direct debit to your bank account. And I've had a few clients utilize that, and they seem to say it works fairly successfully, especially when they're waiting until April 15th and they're nowhere in Portland with their checkbook to get a check in the mail. So that's worked well for some of my clients out of town. Amending your Oregon return. The rules and principles that apply to amending your Oregon return are similar to those for your federal return. Oregon law requires you to file an amended return if the change to your federal return results in additional Oregon taxable income. It doesn't matter whether the federal change was due to a federal audit or an amended federal return. If you don't send a federal report or amended return to Oregon, the Oregon Department of Revenue has 2 years from the date that the department is notified of the change by the IRS to issue a deficiency notice. The deficiency notice will include interest charges. So what this is saying is if you go through a federal audit or you file an amended return with the federal government that changes your taxable income, the IRS tells Oregon about it. The timeline for when IRS tells Oregon about it could be a few months to a year. Not really sure how that system works, but it does eventually happen. And once Oregon gets notification from the IRS that the federal return changed, that's when Oregon is going to be able to say, oh, we think you owe us more money. And since you didn't file an amended return with us to explain differences and voluntarily reveal the extra tax you owe, we're going to send you a deficiency notice. And they have up until 2 years after IRS notifies them to do that. So one of the things I'm very careful to do with my clients, when they get a CP 2000 letter from the IRS telling them that there's been an adjustment to their federal return because they underreported income or they overreported a deduction and they can't dispute it or correct that, I'm essentially telling them, and guess what? Well, now we need to change Oregon. And if I fail to tell them that this will affect Oregon, a year later, 2 years later, they're going to get a letter from Oregon, and the client will, of course, be screaming at me for failure to notify them of this issue. So something I do make a point of explaining to my clients. Now, if you are requesting a refund with your amended return, expect your refund to take up to 4 months to process. That's the instructions in the Oregon booklet. The form itself says 6 months. I'm not sure where the truth lies. If you owe additional tax with your amended Oregon return, you should pay your tax in full. You should include any penalties and interest due with your return. If you do not include additional penalties for interest and penalties that you owe, Oregon will issue you a notice assessing additional penalties and interest owed. You will be required to pay these additional amounts in most cases. Now, how do you file your Oregon amended return? Well, you follow these steps. You prepare your corrected Oregon Form 40S, 40, 40N, or 40P as appropriate. You complete the Oregon amended schedule. You sign and mail your corrected return with your Oregon amended schedule behind your corrected return. So there is some confusion, and it's easy because the federal return normally says put the 1040X on top of the corrected return. And Oregon is saying, no, put the Oregon return on top of the amended schedule. If you also amended your federal return, attach a copy of your corrected federal return behind as well. So here we have the Oregon amended schedule, and it is actually a pretty basic, straightforward form. There's not a lot to it. And of course, beginning in 2010, it is a very different type of form than IRS has. In our class last week on amended returns for the federal, we talked about how the IRS had gone to a schedule that looks a lot like Oregon for amendments, but in 2010 it's gone back to the old methodology of having 3 columns, the way it was, the way it should be, and the difference in the middle. Oregon has actually had this version of its amended schedule longer than the federal had its old version. So Oregon brought in this version about 2 years before the federal changed. The federal then changed for a period of 3 or 4 years, and now it's gone back. But as far as we can see, Oregon's sticking with what it's got here, and it makes it pretty simple. They want you to prepare a corrected Oregon return that looks the way it's supposed to look, and on the form there is a box that you check to indicate that this is the amended form. And then behind that they want you to attach the schedule. And the schedule is basically saying what is the net income as amended, what is the Oregon income tax as amended, and what were the original payments with the original return, or what was the original refund with the original return, and let's figure out the difference that you either owe us or that we owe you. And then there is an explanation of the adjustments made where they want you to describe the lines that have changed and why they've changed or how they've changed. Sign it here. Yeah, and here's where it says amended returns may take 6 months or longer to process, but in the Oregon booklet it talks about it takes 4 months. So you figure that one out. And here is the first password of the day. This password is not associated with a test answer key. First password you need to know is Klingon, K-L-I-N-G-O-N. Interest and penalties is something you really need to be on top of. This is a topic of concern for the exam. You will get several penalty type questions that you should be looking for on that exam. So it's important to memorize these penalties. It's also important to memorize them just for explaining them to your clients and also taking action for your clients or making recommendations to your clients on actions they should take to avoid these penalties. They are more severe in most cases than the federal penalties. We'll begin with the interest on tax underpayment. Oregon rules for payment of estimated tax are generally the same as the federal rules. If you paid less than the estimated tax due on each payment date, or if you paid your balance due late, you will be charged interest on the underpayment. An extension of time to file is not an extension of time to pay. If you do not pay the tax due by the due date of your return, you must figure interest on the amount of tax not paid. Interest owed on income starts the day after the due date of your original return and continues to accrue up until the date of your payment. Even if you get an extension of time to file, you will still owe interest if you make payment after the return's original due date. In other words, there's no way around this interest issue. Interest on underpayment of estimated tax, which is a separate thing. Oregon law requires some taxpayers to make estimated tax payments. Interest is charged on underpayments or late payments of these taxes. You have an underpayment of estimated tax if you paid less than the estimated tax due on each payment date. And you have a late payment of estimated tax is not paid by the quarterly due date. You may owe interest for the late payment or underpayment if you owe $1,000 or more on your Oregon 2010 income tax return. The 2010 interest rate is 5%. Exceptions to paying interest on the underpayment of estimated tax. If you meet certain requirements, you may not need to pay estimated taxes. And following are exceptions to the estimated tax requirements. Exception number 1, farmers and fishermen. If at least 2/3 of your 2009 or 2010 gross income is from farming or fishing, you will not have to pay underpayment interest. Exception number 2, no prior year tax liability. You do not need to pay interest on the underpayment of estimated tax if you meet all of the following qualifications. You had no Oregon tax liability for 2009, or you are not required to file an Oregon return, and your taxable income was a full 12-month period, and you were a full year resident of Oregon for 2009. Note that your Oregon tax liability is your liability after tax credits, but before withholding and estimated taxes. So essentially what this is saying is you can only look to the zero tax liability formula if you were a full year resident the year before. So if in the prior year you were either a non-resident or a part year resident, this exception cannot apply to you. To qualify for exception number 2, you have to have been a full year resident in 2009, and in 2009 you were either not required to file or you had no liability when you did file. Here is an example. In 2009, Merrill Lee and Brad claimed a residential energy credit that reduced their tax liability to zero. For 2010, they did not make estimated tax payments, and their 2010 Oregon return shows tax due of $1,200. $1,200 is a number that is relevant because it is $200 more than the threshold amount where penalty is due. Merrill Lee and Brad will not have to pay interest on underpayment of estimated tax because they meet exception 2. They had no liability in 2009. Their taxable year was a full 12-month period, and they were full-year residents in 2009. Exception number 3, reasonable cause associated with retirement or disability. You retired at age 62 or older and became disabled in 2009 or 2010, and your underpayment was for reasonable cause. Attach a statement to Form 10 explaining the cause to be considered for the exception. Exception number 4, casualties, disaster, or other unusual circumstances. The underpayment was due to a casualty, disaster, or other unusual circumstances, and it would be unfair to impose underpayment interest. Attach a statement to Form 10 explaining the reason for the exception. And exception number 5, S Corporation shareholders who are non-residents or were part-year residents. It's a very specific thing. No interest is due on underpayment of S Corporation income as a shareholder if the income is for the first year that S Corporation status is elected and you were a non-resident for 2010 or you were a part-year resident for 2009. Figuring the underpayment of estimated tax. Interest starts on the day after each estimated tax payment is due. Interest will be charged until Oregon receives payment or until the due date of the return, whichever comes first. After that date, interest will continue to accrue on any delinquent tax due and will be computed separately. Now this is a table or a flow chart that comes from the instructions for Form 10. Now the federal form that you use to calculate federal interest on underpayment of tax is 2210. So Oregon drops the 22 and just calls it 10. And if you go to the instructions for Form 10, they contain this flow chart. And this flow chart is used to determine, do I owe interest on underpayment of 2010 estimated taxes? And it says start here. Do you owe $1,000 or more after withholding and refundable tax credits on your 2010 Oregon tax return? If you answer no, it's saying you don't file Form 10 and you're not required to pay interest. If you answer yes, do you qualify for one of the 5 exceptions listed on page 2 of the instructions for Form 10? And I've got them actually shown below here in the manual today. If you answer yes, then you do not file Form 10, and no interest is due on your underpayment, but you're going to have to write in the exception number on page 2 that you were claiming on Form 40. So you're going to have to make note that there is a reason that you qualify for an exception to the penalty, and you make note of that on Form 40. If you do not qualify for one of the 5 exceptions listed in the instructions, then you answer no and you move down to the next part, which says complete parts A, B, and C of Form 10 to figure your required payments in appropriate method. You will also figure any amount you underpaid and any interest due. Attach Form 10 to your Oregon tax return. Check the box on your Oregon return to show that Form 10 is attached. Now, something very interesting happened with the tax software program that we use in 2009. The software automatically, for the first time in a decade that I'd been using it, started to default and generate this form every time until I suppressed it. So every time my client owed more than $1,000, this form was popping up and generating interest, and so I was having to suppress it if I established that they didn't owe it. And that's an important point to bring up. If your software at the federal level automatically calculates a penalty based on carry forward information from the earlier year, or just somehow makes up numbers and puts them on as a penalty, you actually have to do a lot of legwork and a lot of apologizing and a lot of letter writing to the IRS to get that penalty removed. Once you voluntarily decide to agree to pay an underpayment of estimated tax penalty, it's very difficult to say, oops, I'm wrong, I didn't really owe it, and to subtract it off again. So I've learned that the hard way, and I was ultimately able to get it removed, but it required at the federal level filing Form 2210 and spending many hours of labor going through and explaining everything to the IRS about how the software did it inadvertently and da-da-da-da. So what I'm saying is if you do have software that is automatically generating a penalty, make a note of it and establish whether that penalty is correct and whether it is accurate. In particular, you should be concerned with differences in income. So if a filer had a big boon of income late in the year, That could be a reason to file Form 2210 at the federal level and Form 10 at the Oregon level to show that the underpayment of estimated tax might be attributable only to a single quarter and not to the entire year. So these forms, both 2210 and 10, can be used to annualize income. Now you may use one of the following 3 different methods to figure your underpayment of estimated tax to Oregon. You should refer to Oregon Publication 17.5 for more information. Method number 1, estimated 2010 tax. Use the estimated method if your estimated tax payments plus state withholding are equal to or more than 90% of your 2010 Oregon net income tax. Method number 2, use the safe harbor method if the Oregon tax withheld from your wages plus your 2010 estimated tax payments, that is your required installments, are equal to or more than your 2009 Oregon tax liability after all other tax credits. And under method number 3, you use the annualized method. Use the annualized method if your estimated tax payments plus your Oregon tax withheld are equal to more than 90% of the tax on your annualized taxable income. This method may benefit taxpayers who don't get their income evenly throughout the year or who were part-year residents. Use Form 10 to compute the amount of interest that you owe. So this part-year resident reason is a very good one. You were a non-resident of Oregon during the year, and then you moved to Oregon, and it's very common for part-year residents of Oregon to owe. And when we get into our class on part-year residents, I'll show you why that's common. But ultimately, one of the ways to reduce the penalty for a person who is a part-year resident of Oregon would be to use method number 3. What if I forgot how much estimated tax I paid? That's a common situation. You can call the Oregon Department of Revenue at either of these 2 numbers to obtain the information on the amounts and dates of payments that were made to Oregon. Obviously, you'll either need a power of attorney or you'll need your tax client present to get that information, or you can just have the client call and get the information for you. Here is Form 10. And you can see that Form 10 has lots of numbers on it for calculating the interest owed on late payments. And on page 2, you have space for figuring the annualized income. And this is the sheet that I tend to fill out more commonly when I do need to annualize income for a client who had income that was unequal throughout the year and was not required to pay estimated tax in some quarters, but was required to pay it in other quarters. So we've just finished talking about penalties associated with estimated tax. Now we're going to move on to penalties associated with other bad behavior. In addition to interest charges, you may be required to pay 1 or more penalties. There is a 5% failure to pay penalty. You must pay a penalty if you did not pay tax by the original due date. This is true even if you have an extension of time to file. The failure to pay penalty is 5% of your underpaid tax. There are some exceptions to the failure to pay penalty. You will not be charged the 5% failure to pay penalty if you meet all of the following requirements. Number 1, you file Federal Form 4868, extension of time to file. Or you file Oregon Extension Form 40EXT according to the current Oregon income tax return instructions. And you pay at least 90% of your tax after credits by the original due date, and you file your return within the extension period, and you pay the balance of tax due when you file your return, and you pay the interest on the balance of tax due when you file your return or within 30 days of the due date of the bill you receive from the department. So what this is saying is you file your extension on April 15, and at that point, you need to have a pretty good picture of what you owe Oregon. You look at what the tax liability is projected-wise for Oregon and how much has been paid in so far. If you're within 90% of the total tax, Oregon is saying you're good. But if you're not within 90% of the tax, then you're going to have to pay money with the extension. So let's say you pay money with the extension so that when you file, you can show you did pay 90% of the required amount. Then Oregon says you will not owe that 5% failure to pay penalty. You will still owe interest from the due date of the return up until the date that you pay, but you won't owe the penalty. So it's always important to remember that there are essentially two penalties going on at the same time. One is the failure to pay penalty, and the other one is interest. So it's only the penalties you're able usually to get out of under the rules. Interest usually you can't get out of. So don't be making your clients any promise that everything will be perfect, because that interest is something that is usually owed. And on the flip side, if a person files and gets a refund after the due date of a tax return, then typically interest is paid to that filer by the government as well. So the interest works two-way, but penalties only ever work one way. You can't penalize the government for taking too long to give you a refund, for example. The most you can do is get interest out of them. Now watch out. 20% failure to file penalty is next. You must pay a penalty if you do not file your return within 3 months after the due date, including extensions. The penalty is 20% of the unpaid tax. The failure to file penalty is in addition to the 5% failure to pay penalty. So what this is saying is, at the 3-month mark, the penalty is 25%. Here's an example. Rosa filed her 2010 return on July 21, 2011. Her return was due April 18, 2011, and she did not have an extension. She paid the tax due of $2,000 with the return, and here is how she figures her penalty. Failure to file, 5% of $2,000 is $100. Failure to file another 20% of $2,400, so her total penalties are $500. Ouch. She's also going to owe interest on the late payment of the tax. Exception. You will not be charged the 20% failure to file penalty if you file a federal Form 4868 extension of time to file, or you did the Oregon equivalent. But we're not done. 100% failure to file penalty. If you do not file returns for 3 consecutive years by the due date of the 3rd year's return, including extensions, you must pay a 100% failure to file penalty on the tax due for each year. They're not done yet. Oh, and this one here, this is one I really pay attention to. If I have a client that comes into me, and we all have this, right? We have clients that come in that they haven't filed for 2 or 3 years. And so we're approaching the due date of the 3rd year. And I am absolutely emphatic. We need to get this current year return done on time. Because if it's late, you're going to owe 100% failure to file penalty on this year and all the earlier years. So you cannot overemphasize the importance of not hitting 3 consecutive years with late filing. 100% fraud penalty. If you fail to file a return, or you file a return with the intent to evade tax, you must pay a fraud penalty of up to 100% of the tax due. In addition, you could be charged with tax evasion, a Class C felony. You could be fined up to $125,000, serve a jail sentence, or both. Total penalties, though, cannot be more than 100% of the tax due. Exceptions. Penalties for substantial understatement of income, frivolous return, and abusive tax avoidance transactions may be in addition to other penalties. Here is an example. Dan and Alicia failed to file their 2008 return by April 15, 2009. In 2010, they received a request to file from the Oregon Department of Revenue. They filed a return on April 5, 2011, showing $5,000 of tax due. No payment was made. An investigation completed on October 25, 2011 revealed the intent to evade tax and a corrected tax due of $7,000. And here is how the penalty is figured. Tax due $7,000. Penalties include failure to pay, failure to file, plus fraud, but the total penalty cannot be more than $7,000. 20% substantial understatement of income penalty. If the Oregon Department of Revenue determines that you have substantially understated your income on your return, you must pay a 20% penalty. A substantial understatement of income is more than $25,000 for C corporations and $15,000 for all others. Substantially understated income includes income attributable to an abusive tax shelter, even if fully disclosed. The penalty is in addition to all other penalties provided by law. $250 frivolous return penalty. If you file a frivolous return that is meant to deliberately delay or block the administration of tax laws, you must pay a $250 penalty. Frivolous includes, but is not limited to, an argument without any good basis that there has been a violation of your constitutional rights, or reliance on a gold standard or war tax deduction, an argument that wages or salaries are not taxable income, an argument that the 16th Amendment to the United States Constitution was not properly adopted, an argument that an unenfranchised sovereign freeman or natural persons are not subject to tax laws. Post-amnesty penalty. Oregon had an amnesty program in place a few years ago, and it was widely published. They had television commercials going on it, and people were very much encouraged to come forward under this amnesty and make up for all the back year returns. The amnesty was very significant and very lenient, and anyone who failed to participate in it is in trouble. If Oregon determines that you were eligible for the 2009 amnesty program and you didn't participate, you must pay an additional 25% penalty. This penalty, however, only applies to tax years 2007 and earlier.
And the second password of the day is not associated with a test answer key. That password is Belgian, B-E-L-G-I-A-N.
Oregon filing status. So we've just finished our talk on all the penalties, and as I said, that it's important to know those penalties because you will get asked questions about them. We're now going to move on to a new topic, which is Oregon filing status. Generally, your Oregon filing status must be the same as your federal filing status. However, your filing status for Oregon may be different from your federal filing status if both of the following are true. Your filing status is married filing jointly, and you and your spouse had different Oregon residency statuses during the year. This includes the various combinations of full year, part year, and non-resident statuses. There's also an exception if you are an Oregon Registered Domestic Partner, or RDP. Your Oregon filing status and your federal filing status will be different. As an Oregon Registered Domestic Partner, your Oregon filing status must be one of the following: Registered Domestic Partner filing separately, Registered Domestic Partners filing jointly, or head of household, but only if you meet the requirements for this filing status under Oregon rules. So you could meet the filing requirements for head of household under federal rules because you were single under federal rules. But if you lived with your Oregon Registered Domestic Partner, you would not be eligible for head of household on Oregon. You would have to go Oregon Registered Domestic Partner filing separately or Oregon Domestic Registered Partner filing jointly. And I wanted to do a couple of little illustrations with regards to this filing status choice for married filers who have different residency statuses, because I guarantee you Oregon will ask these questions on their test. So I'm going to give you some possibilities here. We've essentially got part year for one filer and full year. We also have non-resident for one filer and full year for the other. And the final option is non-resident for one filer and part year on the other. And what Oregon wants you to know is, in each of these situations, what is the filing status that must be used? And I guarantee you, even after I give you this lecture and then I give you a quiz to take home, you'll probably bomb this question because you have to pay attention. So what Oregon is saying is, if you have a different filing status than your spouse and you filed jointly on your federal return, so your residency status for Oregon differs from your spouse, but you filed a joint federal return, then in that situation you can qualify to file separately on Oregon even though you filed jointly on federal. And in order to have a different residency status than your spouse, you have to have one of these combinations. That is, that one of you is part year while the other was full year. Or one of you was a full year non-resident while the other was a full year resident. Or one of you was a non-resident all year and the other was a part year resident. Now let's compare that, say, to a situation where you've got two filers, both of whom were non-residents all year. Okay? If you're both non-residents all year, then your residency status is the same. And if you're both part year residents all year, right, then your residency status is the same. So anytime you're looking at a quiz question that's getting at, can these filers file separately for Oregon even though they filed jointly on the federal, you need to be looking for a combination like the combination you see here. And if you can't find that combination because this is applying or this is applying, then that means that their filing status for Oregon must be the same as it was on the federal. And then, of course, that is true only for people who are married. If you are in an Oregon registered domestic partnership, it's completely separate rules. And because the Oregon registered domestic partnership rules are so specific, that's going to be the next topic that we talk about. Filing requirements for registered domestic partners, or RDP. If you and your partner entered into an Oregon registered domestic partnership, and I've highlighted Oregon registered because Oregon registered is the only kind of partnership that matters. In 2010, you will have the same rights and responsibilities as married filers when it comes to your Oregon tax return. Important. Civil unions, domestic partnerships, and same-sex marriages established in other states are not recognized in Oregon. I should point out that this is directly a contrast to California, and California recognizes marriages and domestic partnerships established in any other state and in other countries as well. So if you are a person who entered into a registered, or actually into a same-sex marriage, say in New Zealand, and you move to California, California will recognize that marriage. Oregon will not. Registered domestic partnership defined. You are an Oregon registered domestic partner if you entered into an Oregon registered domestic partnership on or before December 31, 2010. You must follow Oregon tax rules regarding preparation and filing of your 2010 Oregon income tax return. Tax treatments for registered domestic partners. As an RDP, you cannot use the single filing status on your Oregon return. Registered domestic partners are subject to the same tax statutes and regulations that apply to married filers. Just like a married couple, you have the option to file jointly or separately. As a registered domestic partner, you are no longer eligible to use the single filing status on your Oregon return. You must use one of the following Oregon filing statuses: registered domestic partners filing jointly, registered domestic partners filing separately, or head of household if you meet those requirements for that status under the Oregon rules. When you file jointly with your partner, you may be able to take advantage of additional tax benefits, but you will also be subject to additional tax responsibilities. For example, like married joint filers, RDPs filing jointly will be held jointly and severably liable for the entire tax liability. To correctly figure your Oregon tax liability, you will need to complete a federal income tax return as if you are married filing jointly or married filing separately. Use the information that you calculate on the as-if return to complete your Oregon income tax return. The as-if return will not be submitted to the IRS, but a copy of the as-if return needs to be included with your Oregon tax return. General filing instructions. If you were an RDP under Oregon law on December 31, 2010, or if you were an RDP during 2010 and your partner died and you did not enter into a new RDP or marry during 2010, please follow these directions for filing your 2010 return. Complete federal forms 1040, 1040A, or EZ for each partner using the appropriate federal filing status, such as single or head of household. File these returns with the IRS. Use another federal form to complete a return that assumes you were allowed to file a joint or separate federal return. Use all the same IRS rules and procedures that apply to married couples. This is called the as-if federal return. But important, do not file the as-if form with the IRS. Then complete your Oregon joint return using the RDP filing jointly status, or separately using the RDP filing separately status, or other filing status if you qualify. Your filing status must match the status you use on the as-if federal return. Information used to fill in the Oregon returns must be taken from the as-if federal return and not the individual federal returns that you actually filed with the IRS, except for the federal income tax liability subtraction. So the federal income tax liability subtraction is an item that you have to actually look at what was paid to the federal government by both RDPs and use that amount as the forced-in number on the Oregon joint or Oregon separate returns. Now, for that reason, it can be beneficial to file separately for Oregon, because if you file jointly on Oregon, you have to share the limit. But if you file separately, you each get the full limit. So frankly, in our practice, when we do file registered domestic partner returns, so far they virtually have all chosen married filing separate. There doesn't seem to be a benefit to joint on the Oregon level in most cases. Follow these steps to ensure that your income tax returns are filed correctly. File your individual returns or forms with the IRS. After completing your as-if federal return, use the appropriate Oregon Form 40, 40S, 40N, or 40P to file jointly or separately for Oregon. Use the information from your as-if return to complete your Oregon return. Submit the following to the Oregon Department of Revenue: your original federal return labeled RDP Original, your as-if federal return labeled RDP for Oregon only, and your original Oregon return. Also, if you and your partner filed separate Oregon returns, send the returns in the same envelope, but do not staple your returns together. Now, something that is possible, and we are doing it in our firm, is filing our RDPs electronically with Oregon. It is possible to do that with direct e-file. On a joint return, it's exceptionally difficult. But on the RDP filing separately status, it's simply a matter of changing the filing status in the software. So you prepare the software with single for the filer or head of household for the filer, whatever the filing status they meet at the federal level, and you transmit it that way to the IRS. After it's transmitted to IRS, you switch or toggle the filing status to RDP filing separately and transmit to Oregon, and it's able to carry all of that information electronically quite successfully. But to do it jointly on Oregon, that would be a lot more work, because now you'd have to add in all of the income for the other partner before you could send it to Oregon. And for that reason, and then there's no tax benefit ultimately when you do the numbers both ways. It doesn't really seem to come out to their advantage to file jointly, and it's a lot more work.
At this point, I would like you to complete your Classwork 1 assignment, which involves using the Oregon tax tables found on page 3 of the Oregon Full Year Resident Booklet to determine if the following taxpayers are required to file a return. None of these taxpayers can be claimed as a dependent by someone else. So please, at this point, push pause on video playback, complete Classwork assignment number 1, and when you are finished, please resume playback for a review of the Classwork 1 answer key. And I have up in front of you now the booklet for Oregon Full Year Residents. I'm on page 3, and of course we'll just take this together. We're looking over here at the Do I Need to File a Return box, and then it shows the filing status, the age of the filer, and the gross income amount. Oregon says you need to file a tax return if your income is more than the amount shown here. This differs from IRS rules, which say if your income is equal to or greater than the amount shown, you need to file. For Oregon, it's is your income greater than the amount shown. So we look over to the first question in our problem, and the first question is, we have a filing status of married filing joint. One taxpayer is age 67, one is age 65, and the gross income is $11,500. So we're going to go over to the married or registered domestic partner filing jointly. Both are age 65 or older. The income amount is $12,700. That is a greater number than the amount we're showing for gross income. So for question number 1, the answer is no, not required to file an Oregon return. On to question number 2, we have a single filer, age 69. The income earned is $6,200, but we move over and we're only required to file if the income exceeds $6,540. So question number 2, not required to file. Question number 3, single, age 18, $9,000 of income. Is the income more than $5,340? Yes, it is. So number 3 is required to file. Number 4, head of household, income is $10,250. Is this person required to file? We move over and find the head of household column. The answer is yes, needs to file when income exceeds $6,680. Number 5, married filing joint, income of $12,000. Neither filer is age 65 or older. So we go over here, we find that the filing requirement is $10,700. Question number 5, income of $12,600 is more than $10,700, so 5, yes, required to file. Number 6, $7,750 is the income for a qualifying widow, and that more than the filing requirement of a widow under the age of 65, but it is less than the filing requirement for a widow age 65 or older. So number 6 is not required to file, but of course, just keeping in line with that, number 7 is required to file. Number 8, the income is only $4,700, and if you go over and look at married or RDP filing separately, the filing requirement is $5,340. But remember, in addition, file a return if you are required to file a federal return, and the married filing separate category says on the federal return that you are required to file a return if your income is $3,650 or more. This income of $4,700 is more than the federal filing requirement, and since Oregon says you must file an Oregon return if you are required to file a federal return, under those conditions we say yes, number 8 is required to file. Number 7, both filers are under age 65 and filing jointly. The income is $13,500. That is more than the filing requirement, so number 9 is required to file. And finally, we have a single filer with income of $79.50. Regardless of age, that is enough that number 10 is required to file a return. So that concludes the classwork review for Part 1 of our Oregon course on filing requirements, penalties. Let's move on now to look at the homework assignment for today's class. And the homework assignment associated with today's class is actually a pretty easy one. You will complete only homework A, showing on pages 87 and 88 of the student manual. Do not complete homework assignments B or C. Those will not come until the end of our next class. But for homework A, what you need to do is for each of the following individuals, use the tax tables in the Oregon Full Year Resident Booklet to calculate Oregon tax. And let me just open up that booklet for you real quick. And of course, the Oregon tax tables are shown in the Oregon Full Year Resident Booklet beginning on page 37. Your assignment is to look at each scenario here. I will carry out the first one with you, and then you'll be on your own for the rest. Mr. J's filing status is married filing separately. His Oregon taxable income is $33,760. What is his Oregon tax? So we're going to go over to the single column. Find the line that says $33,700 through $33,800, which is in the range of problem number 1 at $33,760. Go to the single column. The correct answer is 2824. Please continue with questions 2 through 4 on your own. And then the second part of Classwork A involves questions 5 through 8. And 5 through 8 asks you to use the tax rate charts in the Oregon Full Year Resident Booklet. The tax rate charts for full year residents appear at the bottom of page 39 of the Oregon Full Year Resident Booklet. Let's do the first one together. Mr. and Mrs. B are filing jointly. Their Oregon taxable income is $159,444. So what we do is we come over to chart J for married filing joint. If your taxable income is over 50 but not over 250, this is where we fall. So what do we do? So what we do is we take $159,444. According to the instructions, we now need to subtract out $50,000, and when we do that, we get $109,444. Next, we take $109,444 and multiply that by 9%. That gives us $9,849.96. The next step is to add in the amount shown on the chart of $4,072. We add $4,072 to the tax we calculated manually, and that gives us $13,922. $13,922 is the correct answer to question number 5. And your job is to finish questions 6 through 8 on your own. And that concludes our first session on Oregon tax law. At the beginning of our second session on Oregon tax law, we will continue with a lecture on Oregon additions, subtractions, and credits. Thank you, and I'll see you next time.